Hi guys, this is Alex with Delmarva REI, and I'm here with...
I'm Shawn Hunt. I'm the area manager for CMG Home Loans.
Good to see you, man.
Good to see you, bud.
Thank you so much for having me here
Thank
today.
you.
So I just want to come over here and ask Shawn some questions because I used to have a lot of questions, and I always email him or call him. And I know of friends of mine that are newer to the investment in the environment ask the same question or should ask the same questions. So I'm going to make a quick video about some questions that I wrote down. So Shawn, how does a mortgage approval or mortgage process differs between a primary residential home to an investment property?
Yeah.
What are the differences?
The process is very similar. I mean, it all starts with a pre-approval where we take an application for you. This should not cost you anything. It does not commit you to anything, but it's working numbers. We're going to pull your credit. We're going to get your income information, your asset information. But then where it's structuring is the requirements for an investment property.
Okay.
The minimum down on an investment property is going to be typically 15%.
Okay.
On that. Most people say 20 because they don't want to pay the PMI.
Gotcha.
So we're aiming for that. There's some different requirements for investment homes like reserves, how much money you have in the bank left over after it's said and done. So we're working through that whole process, with you as well. But that's where it differs. There's not as many programs. It's pretty much straightforward with an investment.
Okay. So since we talked about these requirements, how about the time frame? Like, what does the approval process looks like? Is it the same time frame? Is it fast enough?
For us, it's the same. I mean, for a pre-approval, if you talk today, we can have you an answer of what things look like this afternoon or tomorrow. Now, if you're self-employed and you have like business tax returns, we have to get some of those documents.
Okay.
So if you have them handy, great. It's easy for us to get those numbers that we need. If you need to talk to your accountant or get some things, from them, then it could take us a couple days. But the pre-approval process is easy. As far as once you get under contract to settle, I mean, the average right now is still 30 days to turn to a settlement.
And it's except for the documents you just mentioned about the taxes and everything else, anything else that specifically that you want to have on handy?
Well, normally it's the income documentation. How are you paid? Are you a salary, W-2 employee? Do you run your own business? So we'll ask for different things there. And especially for an investment, we'd like to see where your assets are coming from.
Okay.
So if you're going to put 20% down, is that in a savings account? Is it in a CD? Is it an investment? Where are you pulling that from? Or even a lot of people use a line of credit.
Okay.
For that. So we can document where that money's coming from and know it's there. So if we're writing a pre-approval, we know we can back that pre-approval up.
And another thing about taxes, I know for me personally, taxes is it's a big ordeal.
Yeah.
And let's say today, right now with May, and then to make it happen.
Yeah.
Do you need last year taxes automatically, or do you if you an extension, or you if it's going to be a little later?
If you've done an extension, then we'll base it off 21 and 20.
Okay.
If that's the case. If you have not done an extension, then we would require 22 at this point. So it just depends. Now, looking back at that 2-year average, 2020 was not a good year for everybody.
Absolutely
with
not.
COVID years.
Yeah.
So some people like to get that 22 right now.
Yes.
Because now we're averaging 21 or 22 if you're self-employed.
Gotcha.
If you're a salary borrower and you're just starting out and you have a W-2 wage, maybe we don't even need tax returns.
That's great.
Yeah.
Okay.
But if you already have some rentals, maybe we're using rental income, there's certain forms of that tax return we need to see.
Okay, awesome. And then we have any limitations on or restriction on investment property. Like, I know there's people saying 10 mortgages per investor, whatever. What is it all about? Is it real, not real?
Fannie Mae and Freddie Mac will only finance 10 individual units per person. Okay. Once you have 10, if they're financed under your individual name, then we're kind of stuck going that route. Then we have to look at different investors, maybe broker the loan out to somebody, because there are investors that will do more than 10, individual. Now, when you go to investor, maybe the interest rate's a little, or what I say, investor broker for us, maybe the interest rate's a little bit higher. What's that mean to get that money? But there are options out there, for it. But if we're looking at a normal conventional loan, Fannie Mae and Freddie Mac are going to, require us to max it out at 10. Now, unless, like we've talked about before, if you have an LLC and you're running some of those businesses through an LLC, maybe the LLC has those and not under you individually.
Okay.
So that changes things.
Gotcha. So it's a lot of things. Okay. And then how about, I know we talked about income requirements a little bit. Is rental income, we just talked about it just just seconds ago. How much does it count towards your income? How much do you take?
So the old method of calculating it was we take 75% of your monthly rental and we give, we take that 25% for repairs or anything else that you may have to do to the property. That's the old school way. Now, there's actually a form we fill out where we look at your Schedule E on the rentals and we type in the information, and it shows us your profit or the loss for the year.
Okay.
And that's what we can use to average that out. So if you have a history of rentals, we would get your Schedule E, look at both years or 1 year depending on what we need, and break that down per that form. Now, if it's a property you just bought, maybe we go the old school way where it's 75% of that. So if you rented a house for $1,000 a month, we can use $750.
So it's either or?
No, they'll typically require us to do the form now, the new method with the their spreadsheet that they have, and anybody that wants to sit down, we can show them what that looks like for a calculation purpose. But a good thumb, it kind of works out to be the same thing.
Okay,
almost.
Good.
So it's just the new way they do it.
And then I know there's a big thing about debt to income ratio. Is that also a factor in this scenario?
It is. Well, and that's why we generally want to use rental income. So any income that we can use always helps you lower your debt ratio. Right now, typically Fannie and Freddie with a strong file possibly let you go up to 50% of your debt or of your income. Lately, we've been really seeing them tighten up a little bit and want 45% or less.
45% or less. Okay.
And that, like I said, that changes with everybody. If we're really tight, maybe it's not a strong file, they might limit us to the 45. If you have plenty of reserves, credit's great, things like that, they might let us push to 50. But any income we can use, your salary, your income, your self-employment, the rental income, always helps for that.
Will the assets also count towards it? I mean, how much assets do you have?
No. Assets do not count towards debt ratio. They just help us with the money out of the pocket and potentially with the reserves.
Gotcha. Excellent. And then I just want to go over also, how about the seasoning period? I know before, you had a 6-month seasoning period. If you do the BRRRR strategy, like you buy your rehab, whatever, refi. Is it still 6 months of seasoning, or the Freddie Mac? I heard something about the 1 year.
You mean, are you talking about before you can sell it or rent
before
it?
Before you refi it, if on a refi process.
Typically, the rule of thumb is 6 months, and here's why. Well, for a rate term refinance, just to lower the interest rate, it's typically 6 months because most mortgage lenders do your loan and then they'll sell it.
Gotcha.
So let's say they sell it to Mr. Cooper. Mr. Cooper, if they pay it off or you pay it off within 6 months, then the bank gets hit with what's called an early payoff. Okay. And they generally remove the commission from the loan officer that did the loan, stuff like that. Doesn't say you can't do it, because people do it.
Yeah.
But most people say the 6 months. Now here at CMG, we service 95% of our loans.
Okay.
So if we're holding the loan and you want to refi in 3 months, let's say you did a renovation loan, and we want to turn and refi it, we can do that because we service the loan. So we can do it in less than 6 months.
And also it applies to cash out refi?
Cash out's different. So cash out to use, if we think let's say you bought a home for $100,000, but it's going to be worth $200,000.
Yes.
To use the new value, you have to wait 6 months.
Okay.
If you do a cash out within 6 months, it will go off what you purchased it for.
Gotcha.
So it will go off the $100,000 that you bought it for, not the $200,000 it's now worth possibly. That's the difference. And most people, when they do the cash out, want to use the new value.
Absolutely, yeah.
Because it's going to give you the biggest bang for your buck.
Absolutely.
So in that case, it takes you 3-4 months to do the reno. Hey, let's just wait another month or two, then we'll refi you.
Yep. And I think that's a great idea.
Yep.
Last question I have is I see a lot of people saying different things. What are the most important do's and don'ts? That you want to, especially for, I think that most of the people listening to this are not they're going to be buying, but they're also refining.
Yep.
So you can break it down, like what you're thinking.
Well, I think the big things we want, know where your credit is, know what liabilities you have. The big thing, know your budget. Where does that stand? A lot of people come in and really don't know where they want to be for that. What kind of rentals do you want to start? Are we starting small, or are we going kind of with a family rental more so than maybe a college rental? And kind of working through those things, because that'll help shape us where we need your payments to be, or cash flow is a big thing.
Absolutely.
We want it to cash flow, especially as an investment. So what kind of property is going to give us the biggest bang for your buck, and that could be different for each person. But kind of knowing an idea of what you want your budget to be, how many properties do you want, so we can not only plan for this one but plan for the future.
Yes.
Are you looking to do 2 or 3? Are you looking to do 100? Big thing on how we shape those things.
Correct.
So, and we can kind of advise there, but then we also might say, hey, you really need to reach out to your accountant. You might need to talk to a lawyer. How do we set these things up for your future growth if you're truly going to run this as a business? It's not necessarily do you see yourself in this house for 10, 15 years like we do on a primary? It's, what's going to be the easiest for you and how do you truly want to run your business to work through that. But it comes down to, what's your credit, what kind of liabilities are you willing to spend, or assets are you willing to use, towards it. And then really that budget, so we can really put the puzzle together for you and with you to make it, advantageous to you.
Yeah, being realistic with your budget. And
Correct.
Then, when you say cash flow, I want to say, don't forget, whatever you're saying, mortgage minus your rent or vice versa, that the difference actually you need to split it up a little bit more to take out any expenses for new roof fixture, whatever you need to have.
Yeah.
And what are the biggest don'ts?
Don't open any new credit unless you have to. Minimize your balances. Try not to max out your credit cards, because maxing out your credit cards, especially if you're finishing a project or in a project on an investment, maxing out those credit cards actually drops your credit score right now.
Okay.
And the biggest thing, let us know if you have other transactions going on. So I've done some before where we're talking about this program, but over here they're closing a loan with Hebron or Bank of Delmarva, and we have to might count that as a debt if it's closing before us. So you don't want something to pop up the last second, that we're like, oh geez, or
just
make sure we still qualify.
And don't buy a new car, right?
Don't buy a new car. That's the big one. You get that off. If you have to, you have to. But give us a heads up. On that.
I think the most important thing, and that's what I did when I talked to Shawn in the beginning. I said, okay, I came to him before I purchased the property, and 6 months before I did after I purchased the property, and 6 months before I did the refi, I said, hey Shawn, what do I need to do to get this thing the best terms or the best approval rate that I need to have for an investment property? Tell him what to do. I did that, and then we did one more and one more and one more.
Yeah.
And I'm happy that
Thank you.
Yeah,
I appreciate it. I look forward to working with you
good.
again. And the biggest thing, and as you do, it's a conversation with us. It's business, and we're trying to get through this, but let's be open and honest with it and have a conversation of what are your goals too, so we can help get you there.
Also, Shawn Hunt, I think, if you just send an email or anything, I love it. It's like email immediately the next day or even the day.
Yep.
And answers are straight up and no nonsense.
No,
So
appreciate
thank you
that.
again.
Thank you again. Thanks for having me.
Thanks.